The Intelligent Investor. The Intelligent Investor by Benjamin Graham is the book Warren Buffett calls the best investing book ever written. Graham wrote it in 1949. It has never been surpassed. The central idea is the difference between investing and speculating. An investor buys a business. A speculator bets on a price. Most people who think they are investing are actually speculating, buying stocks because they went up, selling because they went down, reacting to headlines and emotions instead of fundamentals. Graham introduces the concept of Mr. Market. Imagine the stock market as a business partner who shows up every day with a new offer to buy your shares or sell you his. Some days Mr. Market is euphoric and offers absurd prices. Some days he is depressed and offers everything at a discount. The intelligent investor ignores Mr. Market's mood. They focus on the underlying value of the business. Graham calls this the margin of safety, the gap between what something is worth and what you pay for it. Buy at a significant discount to intrinsic value, and even if you're wrong, you don't lose everything. The bigger the margin of safety, the smaller the risk. The intelligent investor doesn't tell you how to get rich quickly. It tells you how to not get poor stupidly. One Up on Wall Street. One Up on Wall Street by Peter Lynch is the most encouraging investing book ever written. Lynch ran the Magellan Fund at Fidelity from 1977 to 1990 and averaged returns of 29% annually, one of the greatest investing records in history. His central argument is counterintuitive. Ordinary people have an investing advantage that professional fund managers don't. The advantage is what you know from your everyday life. Lynch calls this investing in what you know. Before the analysts on Wall Street discovered Dunkin' Donuts, the people eating there every morning already knew it was exceptional. Before the professionals found Walmart, the shoppers in small-town America already knew it was changing retail. The edge isn't inside information, it's observation. Lynch argues that most people walk past 10 baggers, stocks that will multiply 10 times in value, every single day without recognizing them. The coffee shop that's always packed. The product your kids can't stop using. The store that has a line out the door. These are signals. Lynch teaches you how to read them. He also introduces the concept of the 10-bagger, any investment that returns 10 times its original cost, and argues that finding just one or two in a lifetime is enough to transform a portfolio completely. The Little Book That Beats the Market. The Little Book That Beats the Market by Joel Greenblatt introduces what he calls the magic formula. Two numbers: return on capital and earnings yield. Nothing else. Return on capital tells you how good a business is. Earnings yield tells you how cheaply you're buying it. The magic formula ranks every large publicly traded company by both metrics combined. Then you buy the top 20 to 30 companies on the list, hold them for a year, replace them with the next year's top list, and repeat. That's it. Greenblatt tested this formula over 17 years of data and found it beat the market in 14 of those 17 years. The book is deliberately short and simple because Greenblatt's argument is that the formula only works if you actually follow it, and most people won't follow it because it requires buying companies that look bad right now but are statistically cheap relative to their earnings power. The magic formula buys unpopular good businesses. The market's job is to make good investing feel uncomfortable. The formula removes the feeling and replaces it with a process. A Random Walk Down Wall Street. A Random Walk Down Wall Street by Burton Malkiel is the book that the investing industry does not want you to read. Malkiel's central argument is the efficient market hypothesis, the idea that stock prices already reflect all available information at all times. If this is true, and decades of evidence suggest it largely is, then trying to pick winning stocks is not a skill. It's luck dressed up as skill. The most devastating chapter in the book tests professional analysts against dart-throwing monkeys. The monkeys perform comparably, not because the analysts are incompetent, because the market is genuinely difficult to predict consistently. Malkiel concludes that the best strategy for most investors is a diversified portfolio of low-cost index funds. The same conclusion Bogle reaches through a different argument. The book also dismantles technical analysis, the practice of reading chart patterns to predict future prices, with particular ruthlessness. Charts show you what happened. They tell you almost nothing reliable about what will happen next. Malkiel's message is uncomfortable for an industry that sells certainty. The market is largely random. Your edge is cost. Keep costs near zero and let time do the rest. Common Stocks and Uncommon Profits. Common Stocks and Uncommon Profits by Philip Fisher is the book that teaches you what to look for inside a business before the numbers show it. Fisher was Warren Buffett's other major influence, alongside Graham. While Graham focuses on price, Fisher focuses on quality. His most famous concept is the scuttlebutt method. Before investing in a company, Fisher would talk to everyone he could find: customers, suppliers, former employees, competitors. Not to get inside information, but to understand the qualitative reality of the business that the financial statements couldn't capture. Fisher argues that the best investments are companies with durable competitive advantages, businesses where something structural makes it nearly impossible for competitors to replicate what they do. He also argues that a great company held for a long time is worth far more than a good company traded frequently. Fisher's 15 questions for evaluating a company cover everything from management integrity to research and development culture to employee satisfaction. The answers to those 15 questions tell you whether a business deserves your capital for a decade. Most investors skip this work entirely. Fisher argues it is the only work that actually matters. The Warren Buffett Way. The Warren Buffett Way by Robert Hagstrom is not written by Buffett. It is a systematic reverse engineering of how the greatest investor in history actually thinks. Buffett himself has described his approach as 85% Graham and 15% Fisher. Disciplined value investing fused with a deep appreciation for business quality. Hagstrom identifies 4 principles Buffett applies to every investment. Business principles. Does the business have a consistent operating history and favorable long-term prospects? Management principles. Is management rational, candid, and focused on shareholder value? Financial principles. Does the business have high return on equity and strong profit margins? Market principles. Is the business available at a significant discount to its intrinsic value? Buffett never rushes. He waits. He calls it being greedy when others are fearful and fearful when others are greedy. The best time to buy great businesses is when everyone else is selling them in panic. Buffett also introduces the circle of competence, the idea that you only invest in businesses you genuinely understand. Staying inside your circle matters more than the size of it. What you don't know is where the real risk lives. Thinking, Fast and Slow. Thinking, Fast and Slow by Daniel Kahneman is not an investing book. It is a psychology book, but it may be the most important book an investor can read. Kahneman won the Nobel Prize in economics for his research on how humans actually make decisions, and the findings are not flattering. We are not rational actors. We are pattern-seeking, loss-averse, overconfident creatures who make predictable and costly errors in judgment. System 1 thinking is fast, intuitive, and emotional. It is what you use when you react to a market crash by selling everything. System 2 thinking is slow, deliberate, and analytical. It is what you need to do the opposite. Kahneman identifies the most dangerous cognitive biases for investors. Overconfidence. We consistently overestimate our ability to predict the future. Anchoring. The first number we hear distorts every subsequent judgment. Loss aversion. Losses feel twice as painful as equivalent gains feel good, which makes us hold losing investments too long. The planning fallacy. We systematically underestimate how long and how hard things will be. Kahneman's book doesn't tell you what to buy. It shows you the enemy. The enemy is your own mind operating at full speed in a domain that rewards slowness.